Subclass 1.7, short-term reinsurance policy, part 1. So the definition of reinsurance is insurance that is purchased by an insurance company. In addition to its basic role in risk management, reinsurance is sometimes used for tax mitigation and other reasons. The company that purchased the reinsurance policy is called a ceding company or a cedent or a cedant under most arrangements. So just to clarify this for you, here you are standing next to your beautiful car. I'll try the best to draw a nice car. There's your wheels, and there's your windows, and you want insurance for this vehicle. So you approach your insurer A. You pay them a premium every month, and they insure your vehicle. So that should something happen to your vehicle, you have insurance which will pay you out. But now, your insurance company, they don't have enough money to pay all the people should something happen. So they get a reinsurance company B. So they pay them a premium. So should you put in a claim, your company will put in the claim to the reinsurance company. The reinsurance company will pay your insurance company, and then they take the money they're getting here. They take that money and to pay you. So they don't use their own money. I hope it makes sense and that you understand it. If not, you're welcome to email me and that I explain to you again. All right, so reinsurance. Reinsurance occurs when multiple insurance companies share risk by purchasing insurance policies from other insurers to limit the total loss the original insurer would experience in case of a disaster. So let's say they've got 2,000 clients on books that pays them every month insurance premiums. But now suddenly there's floods like that happened in KZN, I think last year or the year before. Look at all the houses that was demolished by water and floods, etc. There were hundreds and hundreds and hundreds of people who put in claims. The same when COVID came. All the restaurants and people, the damages, they couldn't open, so they had claims. So yeah, it's a disaster. And then the insurance companies will go down. So that's why they reinsure in case of a disaster. So by spreading the risk, an individual insurance company can take on clients whose coverage would be too great of a burden for the single insurance company to handle alone. When reassurance occurs, the premium paid by the insured is typically shared by all of the insurance companies involved. So reinsurance can help a company by providing, the main thing is what they do, risk transfer. So instead of your insurance company taking the risk, they reinsure and the reinsurance company takes the risk. But they must pay a premium to them. So companies can share or transfer of specific risk with other companies. And then the second one is arbitrage. That is additional profits can be garnered by purchasing insurance elsewhere for less than the premium the company collects from policyholders. So let's say you pay 1,000 Rand a month to get your vehicle insured per month to your insurance. But look here. But they only pay, I don't know what, but I'll just take an example, 500 Rand a month for reinsurance. And therefore, they make a profit of 500 Rand per month on each and every client. That is how they also make money. And then the last one, capital management. Companies can avoid having to absorb large losses by passing risk, and this frees up additional capital. Solvency margins. Let's look at the solvency margins. So solvency margins is the purchase of surplus relief insurance, allows companies to accept new clients and avoid the need to raise additional capital. And then you can look at expertise. The expertise of another insurer can help a company obtain a proper rating and premium. Reinsurers. The lay person's definition for a reinsurer is simply an insurer for an insurer, while reinsurance can be viewed as an insurance policy purchased by an insurer. An insurer pulls all of its policyholder premiums in a capital reserve account from which it has to honor all claims. It has to honor all claims. The size of the capital reserve determines an insurer's capacity for risk. Why is reinsurance necessary? If an insurer exceeds its solvency margin, it can either stop writing new business, find a way to increase its capital, share risks with other insurers, or approach to the reinsurance market. Or approach the reinsurance market. Reinsurance is a valuable tool that allows an insurer to issue more policies with higher limits than it otherwise could by transferring part of the risk of loss to a reinsurer or group of reinsurers. So the benefits of reinsurance. Reinsurers are a crucial part of the insurance sector, as you can see on my drawing. This type of insurance business contributes to the stability of insurance markets and by association to the wider economy. A short-term reinsurance policy serves multiple functions, including improving the insurer's risk profiles, so the insurers got less risk because the reinsurer is taking the risk, financial soundness for the insurer, the diversification of exposures and greater domestic market underwriting capacity. Reinsurance is necessary because few insurance companies could remain solvent if they had to compensate hundreds of policyholders following a worst case or catastrophic event. So it saves them for paying hundreds and thousands of claims. They can just get it from the reinsurer. Legal principles. So reinsurance is a contract under which one party, the reinsurer, undertakes to support the other party, the cedant, or your insurance company, in other words, in respect of the latter's involvement in original risks. The standard definition of reinsurance in English law was made by Lord Mansfield in Delver versus Barnes in 1807 as a new insurance affected by a new policy on the same risk which was before insured in order to indemnify the underwriters from their previous subscriptions, and both policies are in existence at the same time. So that's the definition of reinsurers. Insurable interest. Insurable interest has been defined as the legal right to insure arising out of a financial relationship recognized at law between the insured and the subject matter of insurance. Any insurance taken out without insurable interest will be deemed to be a waggering contract and therefore unenforceable at law. So there must be an item to be insured. There must be something, a legal right. Good faith. Both parties to the insurance contract are under a duty not just to refrain from making misrepresentations, but to fully disclose all the material facts about the proposed arrangement. So your insurer must give you all the information, policy holdings, the document, what they will insure, what not, uh, anything. But so they must make certain disclosures to you, but you, as the insured, must also make certain disclosures to them, like your claim history. Have you been in accidents before? Did you claim before, etc., etc. As reinsurance is a type of insurance for the purposes of contract law, the same duty of disclosure falls upon both the cedant and reinsurer. In other words, your insurer must also disclose all the relative information to the reinsurer, and the reinsurer also have to make certain disclosures to your insurer. For direct business, although the duty applies to both parties, in practice, however, the onus tends to rest primarily upon the proposer, and in reinsurance, it falls upon the cedant, which is your insurance company. Indemnity. There is a difference between original insurance and reinsurance. In original insurance, not all covers are contracts of indemnity. Life insurance and personal accident contracts are known as contracts of compensation because it is impossible to provide an exact financial indemnity in respect of the loss of life, health, or limb. You don't know when you're going to die, or you don't know how long are you still going to be healthy, or when are you going to lose a limb. You don't know these things. And the last bullet, all reinsurance, including life and personal accident business, are contracts of indemnity. This is because in reinsurance, the reinsurer's liability is limited to some part of the original loss that the cedant has suffered under the underlying contract. So the moment you claim from your insurer, he's the cedant, he suffered that loss. So you know that moment I'm suffering. There's a date that he can connect to that suffering. And therefore then he can claim from the reinsurers so that they can reimburse them. Privity of contract. A contract exists only between the parties who have entered into the contractual relationship. The contract creates personal rights that one party has against the other or others. A reinsurance contract is one entered into between the cedant and the reinsurer, or the cedant is your insurance company. The original insured is not a party to this and has no right of claim against the insurer. So, in other words, you, as the client, don't have any right to claim from the reinsurer. That is your insurance company. Only they have a right to claim from their reinsurer. So, what are the benefits of reinsurance? As explained, reinsurance is a form of insurance for insurance companies. So, the insurance companies also take out insurance from a reinsurer. It's a way of spreading the risk more widely. The benefits of reinsurance are likely those of original insurance, in which some degree of financial uncertainty is removed from the insured party. So your insurance company don't want to take the onus of the claim on them uh, because they are maybe afraid of financial uncertainty. Therefore, they take out insurance against claims from the clients. Therefore, the main benefits of reinsurance are those of risk spreading, capacity boosting, solvency margins, financial advantage, financial stability, and protection against catastrophes. Catastrophes. Risk spreading. Insurance is a response to the perennial problem of risk and uncertainty. All are exposed to the risk of loss, but we cannot accurately predict which of us will suffer actual loss. Reinsurance continues the basic principles of insurance by spreading the risk even wider and protects the insurance fund of the original insurer. In this way, additional security is provided not only for the insurer but also for the policyholder. Capacity boosting. The capacity of an insurer is the amount of insurance business it can accept or is willing to place at risk. However, governments supervise insurance operations so that in South Africa the capacity of an insurer is a combination of what it might like to underwrite and that which the government allows it to accept. Solvency margins. A solvency margin is the amount of which assets must exceed liabilities. So they must have more assets than liabilities. In other words, more money than expenses. So the higher the amount of assets when compared with liabilities, the greater solvency margin. So the reason is if they have to pay out and they have financial difficulties, they've got more assets that they can sell to get more money to pay the expenses. Financial advantage. Reinsurance boosts capacity and allows underwriters to write larger amounts of business than they would with just a net line acceptance. And this generates two benefits. And they are only offering a small line to the market will mean that an underwriter will see much less business than organization offering larger capacities. And then the last one, the administration costs are very similar for either a small or a large acceptance. Writing a large amount boosted by reinsurance promotes efficiency in administrative costs. That's the end of part one. And you know what to do.